Hey guys, Market Sniper. We did a live stream yesterday, the commodity macro bull. We were pointing out that the commodity macro bull is definitely on the bigger time frame, but that you may be getting a possible localized high on some of the runs. There were a number of reasons why we said that, but let's just listen to a very short segment, and to make sure it's short, sweet, and punchy, we'll put it on 1.25. While you're getting ready to do this, please hit the like for this short, a little bit of an educational and a free learning element for this. We do this in our regular, almost daily and sometimes thrice daily updates when big things are setting up in our premium community. And you'll get a small heads up on this one. It's a free gift, I suppose, on what's going on. Let's just hear what we said yesterday in that mini segment.
Engineered the loss of value is leading to all of these commodity climbs. Let's have a look. That was your oil. That was your spiller all the way through to single digits over here, which you remember we've covered it countless times. And of course now look at how quick that has bounced up. Let's try and draw that again one more time. Down and then wham. Now you have run literally the highs of the reflations of 2011 and the eventual spiller in 2014. The spill of 2014 came on the Crimea-Ukraine scenario where it kind of was going to go to war and then didn't. Boom, 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 bosh. That was it. That was how it fell. So we've had a couple of interesting bear calls on oil, and this most recent one being long. But are we at a place where it would be no longer safe for anyone to chase in long? I'm going to make the suggestion that localized, please understand, we get so many people in comments that go, oh, you were wrong, or you called a top. Localized high is not calling an end to a super macro commodity bull. It's really just starting. However, you can get points where you have to have a rest, especially, by the way, you got a $12 on the WTI opening gap Sunday night. I was looking at my device, battling to get data, and then I was running into a restaurant and getting this, and I was like, hello there, Mr. WTI, $12. We'll show you that gap in a second, but that was...
So we were pointing out to a couple of key points yesterday as to why we are still macro bulls, the big commodity, but particularly with reference to oil, which has been one of the most substantial markets that exists in the oil realm, that in fact there was a potential for a localized high. We also made reference in that to a gaps. So let's just take a look at the action since then today. First of all, I made reference to McClellan, and I didn't put a link below. This was a very useful tweet that he put out some time ago. Oil went subsequently quite a bit higher, by the way, up to around here. But he was highlighting the backwardization. So this is kind of technical. Some of you guys might go, I don't get it, I don't understand. The key element is here that when the contracts, the red line, is in backwardization, which is on the high side here. See this scale? It's on this red scale. We're looking at the red scale here. Let me just do that rather with my boxing. So the red chart and the red scale is what you're looking at, and the zero line here. And you're seeing the pivot. Extreme vals of backwardization, which is, without getting too heavily into this, it's the cost of future oil relative to the oil now. And this is called contango, when you're very near the lows, when you're getting the opposite effect in terms of time value on the commodity. Whenever you're getting at exceptionally high levels of backwardization, you're often near sell-off points. Note there, and again there. That actually gave us our single digit thriller and spiller that fell down here. I'm going to go with a blue because we're so big on the reds and blacks at the moment. That saw the single digit run of oil, by the way. So that's on that scale, that's dollars of oil, but down to there. Coming out of that backwardization over there. And of course, we were the 2014 Ukraine war that I was referring to in the beginning part of that big spiller there that eventually took you into low levels of contango where it became a buy on oil, and this was the super buy on oil with that over there as well. So that was a very useful chart that was shared, and I gave credit to the Twitter handle that I will now tell you, and the chart sharer, which was McClellan, and that's his website if you're interested in him. I'm not a big believer in indicators but as a general market person, I think is quality. So let's just have a look at that. That's where it was saying. So guys were asking, thanks again, Francis, do you have a Twitter of the guy you mentioned? And I hadn't shared it. So here he is, McClellan Os. Get that spelling right. It's Tom. Solid feed, posted the backwardization that was going on. Now we did this before you had the sell-off that you're looking. So let's have a look at that chart and how you would have played it. So this is small bit of learning that you may get with tactical trading inside of HVF method in our community. So inside the community, let's just show, last night I was saying gold made target. So this is just in the leaders update where we do gold had made target, pullback time for gold and oil. I'd already discussed the structure. In fact, we'd already had 2 little taps that had failed. How many people tell you that they have failed trades? Very tight stops. We're asking, is this the top? Is that contango? That over backwardization, a time to move off? And we had 1 or 2 push-ups. So this, they'd already been seeing the chart that we were looking at. And the gold making target is the value of HVF method and the value of macro 360 degree. Because if you're going to have a little bit of a let up on the precious metals charging higher, it's quite possible and potential that this is also going to manifest in what you're seeing in the oil market. So let's just have a look at that chart again. This is also gaps. We cover this in our theory, but I'll just give you a short, cheap learning, I suppose. That was a potential exhaustion gap. It was extreme. That was $12. I highlighted it yesterday in the video. You heard it. I highlighted it again very much in my community at great length, the significance of that. Whilst this was your breakaway gap to run you through the key level of significance, that's right, the $100, that gave you the upside pole, the bull pole. We're the only people that have megaphone theory because we're the only people that have defined it correctly. And in this instance and in this form, an ascending megaphone on a bull pole, it is typical of potential exhaustion. Plus, that is another reason why we went for the extreme exhaustion gap and referring it to an exhaustion gap, not a continuation gap, which is ongoing gaps on something that's being bid up very aggressively. Marginally higher high over here, boom, 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 very marginally higher and quite a nasty little snap down. And we're the only people who put splitters because we understand the axis inside HVF method, we understand broadening structures, and we have real theory that is being thrown down. That's what you get with us. The price behavior was clinging to the splitter in grinding behavior. What exactly is that the man is saying? Understand the language. You will learn about basing ascending grind lines and why they're interesting if you chose to, and you would go to WW the market sniper. But that is the sleeve with the poke out exhaustive rally that makes a marginally higher high. Bearish for us. That is bearish, my friends. And that is clinging the sleeve, and it wasn't clinging anywhere. It clings on the splitter. That is the midpoint in finishing the third cycle after doing 1, 2. Often as it gets broader, it's got a bigger journey. It parks up at, you guessed it, the splitter. And of course you have the basing ascending grind line done in bigger and red because that's the level we expect to see break. And there was the final break, but you wanted to get short last night, which is what we did. In my case, thankfully I'm on that time zone that I could do it. It was grindy, hanging the splitter was perfect. Where's the lost stop go? The lost stop goes there. Because you're asking it, go and make another high then. Could it have done another high and still come down for a third one and then gone? Very easily. It was speculative. Sometimes you win, sometimes you lose. That's the nature of the game, but that's the technical setup of a trade. So you're short on there. Then you get the spill that was steady down to the base of the megaphone, and then you get the release of the megaphone. And of course, someone will say, but you're lucky. There was some news somewhere. There's always news. That's technical analysis. It's getting the news before the news. Some senator said something, they're going to release oil reserves, who knows what. I don't even know what the story is. It'll show up on my Twitter timeline long after the trade has been made and the money is made. You get the news last. You get the news last. This is what we keep saying. So breakaway gap, that's what you learned. Exhaustion gap. Because it's also in a typical structure that represents exhaustion after an upside move, broadening but with higher highs but ever lowering lows, not lower than the previous lows but expansion, and clinging to the splitter. So you learned quite a bit here today, totally on the house from us, and you could see the trade you could have been in. Learning is only part of it. Implementing is the big story. Understanding and seeing practical market trading. So that was a little follow-up on the original tweet. Let's just give you the original video. Let's just give you the McClellan one more time. It's worthy follow if you want to follow MCCLL, and then that's OSC. I'm also on Twitter. You should be following us there. You should be following the Crypto Sniper as well as the Market Sniper. That was a tactical trade. So you can, in extreme cases, if you're tactical of time frame and you're ready to cut and run and you're not going to eat losses and you've got real money management, what you just saw was in fact a short against a very powerful market that I expect to be higher in 18 months time. However, when you get to localized possible highs, as the video was warning you, localized high, that was the heading of the video when you saw it. You were warned not to go long. I do not encourage counter trend short trading on YouTube with people that are unsupervised and leveraged. I simply don't and won't do it. I don't even encourage it in the community, but that's a trade I took and we mentioned it. And I did reference gold. This is also the competing point, the very important point about 360-degree analysis. 360-degree analysis is absolutely essential. And where did we get that? We were talking about the gold and the relevance of the gold. So let's just take you into gold markets. Gold markets, So here we go. Here's the gold. Whoops, there's your target. Now, for those of you that think, I don't think I need to learn how to do his method. I'll just listen on YouTube and I'll freebie it. Good luck. Good luck. You think you've learned a lot? I'm delighted for you to learn a lot. That's why we give things free for people to learn a lot. But the real value is in the implementation, my friends. I could give all the theory away from you. If you have no one to implement it with, you'll be making errors countlessly. You don't just get given the manual on how to do brain surgery and start doing awesome brain surgery. And I'm afraid if you don't see that and you freebie getting through the YouTube, well, good luck. This was once, and remember, we were inaccurate on this. We were saying that we didn't like this grind line, and we didn't like this grinding behavior, and we didn't like how hard it came back down. We thought it could actually be down. So let's first absolutely own that and remind everybody we said that. Once it breaks, what was the third high? It's clearly a long. We do the target, and that's when you should get out. And that means your silver will probably have a small pullback. A number of things will have a short pullback. And guess what? You've been waiting because of the backwardization, which is a fundamental data factor that ties not to technicals per se, but relative valuations on forward and current spot markets. You know it's getting overextended. You know, even though it may be a macro bull, you can't have too much of that. You're at all-time extremes, and it went more extreme from that tweet chart that I actually showed you. Plus now you're getting gold that was going to make its target of 2057 before having progress, decay and pullback. Is he calling a top and a short on gold? No, don't do that to me. I hate the basic comments sometimes that come in YouTube where they don't listen to the specifics of the language. This is a success. The feedback is you've had an upward pattern make target. That means in future it's quite likely continuation should be expected. However, in going up, especially when you've gone up super fast, super strong in a very short time frame, there can be sustained periods of underperformance and congestion before you wind up again to go up again. So the macro is still a bull on all levels, even though, as some might say, we are warning that this is not too far off a double top. It depends. If you've got a deflationary event, it could turn out a bit. Otherwise, if we don't get a major deflationary event, this could be a big continuation pattern representing something like that. But the key element is it wasn't the right time to play the commodity long trade yesterday, because we knew across other commodities and precious metals, which is commodities, currencies, money, everything category, we were reaching targets. And as a result, we're expecting pullback. Plus, we have an overextended oil market. That is all the skittles that were accumulated that gave the justification for a potential counter trend trade in that event. So hopefully you've learned something. If you like learning things, you want to be a better trader, you want to also understand the value of implementing it and the need to do that, then this video and going to themarketsniper.com, booking a call. It's not for everybody. We don't accept everybody. If you have fantasies about overnight wealth, I'm afraid we're not your guys. You want to learn a skill that could see you work from anywhere in the world. You're interested in not only what you make, but what you keep, the money management principles, and growing slowly, steadily, and consistently, then it could be. Costs nothing to chat. And of course, we have doing a physical event that you could still attend if you moved in good time. That's all for now, guys. I hope you enjoyed it. Just a short follow-up on a video that had just gone, and it was kind of topical, so I've knocked this one out. Let me know if you value it. What next for precious metals and oil? We like your comments. I would like you to tell me which are your favorite commodities for the big macro bull run. Which one do you like? Do you want some equities? Are you going into the individual base metals? Remember, batteries, lithium, nickel, cobalt, manganese, these things, quite thin markets, but they can be traded in some instances. All of these interesting concepts. Where are you looking for the big commodity bull? And do you recognize it's not the moment right now, but that's not a short call? Okay, bye for now.